Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Tuesday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So today we're going to go over the overall portfolio value. Of course, the metrics on the performance are buying power, how the individual stocks are performing, and then of course what I plan on buying with that dividend income and with the upcoming dividend income that we're going to be getting in April. So let's jump right in. Right now, the portfolio value sits at $53,075.85. We are having a red day, down about $390. Not a big loss here, but I actually prefer red days because that means we can possibly buy some quality companies at a discount. So for the 1 day mark, we are down, not a huge deal. For the 1 week mark, though, we are up $238, about a 0.5% gain. Then we are up $1,500, right around a 2.9% return for the past month. Then we're sitting at a $3,200 gain, 6.5% for the past 3 months. Then we have a $3,200 return, about 6.5% for that year-to-date mark. Then we are up $2,700, up 5.5% for the past year. And then all time, we were up $17,700 with a 50.2% all-time return. And guys, I love looking at this graph because it shows the hills and valleys, those peaks and those dips that you have to deal with as an investor. Whether you own an ETF or individual stocks are probably going to be a little bit more volatile, but every investment that you ever put your money into is going to have some type of volatility. So this is a great illustration of why it pays to stay in the market and just keep investing. I've made a lot of money over the past 5 years, but if I would have pulled out during that $54,000 mark, I would have missed out on a lot of dividend income. And if I would have, pulled out during the COVID crash, I would have lost like $20,000 in gains. So just staying invested, even though it might be difficult sometimes just due to the psychology of the market sentiment, and the overall reaction to the economy and where it's going can be tough. It does pay long term to stay invested. Next, we have that buying power sitting at 105.43. Guys, I'm just going to let this sit and I'm going to enjoy the compounding in the account because 105 doesn't buy me a whole lot of anything. So I'm going to wait until I get that monthly dividend income that's scheduled for April, which would be Altria, Realty Income, and Coca-Cola actually just paid me yesterday. But that dividend income is going to be pretty substantial and I will be able to invest at whatever makes sense at that time. Now, jumping into the individual holdings, first off, we've got Realty Income sitting at $52.83, 170 shares, right around $9,000 worth of market value. Our average cost is sitting at $65.03. Around 17% of the portfolio is in Realty Income. Today, we're down $107, about 1.2%. Total, we're down almost $2,100. With about 19% loss, with of course a dividend coming in the middle of the month of April of $43.69. So guys, I love Realty Income. This is one of my favorite stocks simply because I like real estate. I want exposure to it, but I don't have the capital in free cash to buy a property. So what I would rather do is just let Realty Income manage my real estate portfolio for me, essentially. I love the business. I love the business model. I love a lot of their top tenants, and I've actually invested in some of them myself in the past. So I understand they're high quality companies as well as the acquisitions that they've been doing for the past few years. Now, interest rates are up a little bit more, which is why that stock price has dropped down because now they use debt to finance new deals, and that debt is going to cost a little bit more. But I do like the acquisitions that they have accumulated over the past 3 to 5 years since I've been investing. They bought Spirit Realty, and that boosted up their overall income when it comes to monthly payments due to their tenants, and they spun out their office, the office buildings within the company, and I think that was a substantial green flag for me because I don't think those properties would amount to much when it comes to rent and growth in the future. So I love Realty Income. This is my favorite real estate stock, and I do plan on buying more. And I wouldn't be opposed to reinvesting the dividends back into Realty Income when Altria pays me, but I do want to get VISO inside the portfolio, and I think that is where I'm going to allocate that capital. But if Realty Income is still a shining, a glaring deal, a shining falling star in the portfolio, I might reallocate those dividends. And I think I could get about 5 to 7 shares of Realty Income for that dividend. And of course, like I said, we do have that monthly paying dividend from this stock. Every single month we get that $43.69, and it goes up because they increase it usually every quarter, and that just helps the dividend income grow each and every month. So I get paid a little bit more every month simply by having Realty Income in the portfolio. Next, we've got Altria sitting at $43.04. Now, this is one of those stocks that is always out of favor. People hate the stock, people hate the product, and I totally understand it. I understand why you would have an ethical reason not to put money into this company, but I've smoked in the past and I want to get some of my money out through dividends to pay me back essentially from that free cash flow. So I've got 320 shares of Altria. Today it's sitting at $13,700 worth of market value. Average cost is right around $47 per share. 26% of the portfolio is in Altria. Today we're down $56. Total we're down a little over $1,300 with around a 9% loss on the company. But a dividend coming in on April 30th of $313.60. So guys, that is the main reason why I enjoy owning Altria, is that substantial free cash flow from dividends, and it still grows, guys. I've owned the company for I think 4 years now, and the dividend has gone up, not substantially, but enough that it makes a difference due to the high share count. And this is one of those companies that I fundamentally understand. I understand the economics behind the company, and it's usually out of favor. So I can almost always guarantee that it's going to be a stock out of favor, which means I can buy shares at a lower price and bump up my average return and keep growing that dividend income. Next, we've got Coca-Cola. This is one of my favorite companies, one of my favorite products. I'm literally drinking it right now as I film the video. 15 shares, $900 worth of market value. Average cost is $60.54. 1.7% of the portfolio is in Coca-Cola. Today we're down $6. Total we're down $4.30. So guys, this, like I said, is one of the companies that I want to boost up. That 1.71 is nothing compared to what I want this stock to be. And I'm so glad that I bought this, because this will be, I mean, just like every position is, but this is going to be a live demonstration on why it's so important to build up quality in your portfolio, because $7 is what it paid me this past week, guys. So yesterday it paid me $7. $7 isn't a lot. I don't even get enough money from Coca-Cola to buy a 6-pack of Coca-Cola. And so to some people, they might say, there's no point in this. It's only $7. Why would you be so excited about that? Guys, that's free money that made interest on my money. I had to work for the $900. I put it into the company and it spit out $7. So it's not, a phenomenal rate of return, right? But it will grow over time. It will compound, and that $7 will soon be $70. And then that's a share of Coca-Cola that I will forever, as long as it pays a dividend. It doesn't even have to grow, as long as it pays a dividend and the stock price doesn't go up or down too much. Doesn't rise too much, then I can always buy a share. I call it dividend efficient. So that's the goal with Coca-Cola, but instead of buying 1 share, I want to be able to buy like 20 shares every time it pays. So it'll take time, but it is one of those newer positions, smaller positions that I can show you guys over time building. Instead of seeing 320 shares of Altria, you might say, okay, it's easy for you. You got $14,000 in that stock. I don't have $14,000, and it might be a little unrelatable to the average investor. This is new. Right? This is just literally dividend income being put into a stock live. So I only have $900, less than $1,000 in it, right? Only paid me $7, might not be worth it, but over time, it's going to be a juggernaut within the portfolio. Then we've got Apple. Now, this is my favorite company in the entire portfolio. Sitting with one share, $170 of market value. Average cost is right around $133 per share. 0.32% of the portfolio is in Apple. Today we're down $1.20. Total we're up $36 with a near 27.3% return. So 27% return on Apple stock. Now guys, this is a different situation from Coca-Cola simply because Apple does not go on sale that often, and I understand that. So I got some exposure at 132. And I don't plan on buying it until it drops to like 130 or lower than my average cost. So I'm going to be sitting here for a while on Apple stock. And some people, have talked to me about it on Instagram and said, well, if it's your favorite company, why don't you just buy it? Well, because I feel like it is a little bit overvalued at this price. I'm not going to bump up my average cost simply to own more. I have an intrinsic value for Apple at around $140. That's why I bought it at 132. Above 140, I don't want to touch it. So unless it goes below my average cost, I don't want to buy it. And I can stockpile cash and wait for a AbbVie situation with Apple and just pour money in. If I, at $130, if I put $10,000 in, or say I put like $13,000 in at $130, I have 100 shares of Apple, right? At that lower cost basis. Then when it recovers, like I believe Apple would, to 170, I don't have a $36 return at 27%. I have a much greater return. Now the overall percentage might be the same, but the dollar amount is going to be higher simply because the amount of capital allocated to Apple stock. So I want to own more Apple, but I don't want to own it at any price. I want to be very disciplined at when I buy the company, even though I think it is the highest quality company, that in Microsoft, in the market, and I think it will have substantial returns, and I understand the business very well and the economics behind it. I also don't want to buy it at the wrong price and then lose money on a great company. Then we've got AbbVie. Now I've got 95 shares sitting at $180.63, $17,000 worth of market value. Average cost is $95.19. 32% of the portfolio is in AbbVie. Today, we're down $10. Total, though, we are up $8,100 with a near 90% return. So, guys, this is exactly the returns I want to see on Apple. This is why I bought it at the low price that I did when it comes to AbbVie stock. And I thought the companies together, I bought it near an acquisition, would be worth $150 to $160 per share. High point would be like $180, and I was right. And that analysis is paid off, and the dividend has grown. So the overall return is actually above 89%, because even though I didn't put the dividends back in because it's at such a high price, it still should add to that total return. So I plan on watering AbbVie until the dividend gets cut or until I feel like the business fundamentals change. So I am a very big advocate of Peter Lynch. I've read multiple books of his, and he says a lot of people invest incorrectly simply because they water the weeds and they cut the flowers. They focus on their losers. They cut their winners, like what AbbVie's doing right now, and they pour it into something like right now in the portfolio is Realty Income. I'm not going to sell AbbVie to buy Realty Income because I think AbbVie has got a long road ahead of it, and I will miss out on substantial returns and overall returns for the portfolio and for my free cash flow as well for that monthly dividend income. So I plan on owning AbbVie for a very long time, and the only reason that I would cut that flower is if I felt like the fundamentals changed within the business. Then we've got T. Rowe Price down a little bit today, sitting at $118.38. We've got 100 shares, $11,000 of market value. Average cost is right around $110 per share. 22% of the portfolio is in T. Rowe Price. Today we're down nearly $200. Total, we're up $860, up almost 8% here on T. Rowe Price. And guys, this is just like the Apple situation. I have an intrinsic value of calculated for T. Rowe Price, I'd say around $120. So I think it's at value right now, or around it, and I don't want to go above that. But my average cost is even lower, so I'm obviously not going to be picking up shares right now. But I think these T. Rowe Price shares have a substantial opportunity for growth. So I think overall T. Rowe Price, I think the intrinsic value when I bought it was 120, just due to the overall economy and whatnot. If I think that, I do think that it has room to grow, but let's say my analysis says that it's, I redo my analysis and I think it's worth $180 a share, then at 118 it would still be a crazy buy, right? So I have my average cost, I have my share count, and I have that passive income, and it's still growing because even though I don't plan on buying more shares at T. Rowe Price, they were valued at over $200 a couple years ago. So if I see that potential upside of 50% plus that dividend growth every year, even though the growth might not be crazy double digits right now, simply because of how the economy's been performing and how asset managers have been bashed because of it, I do see substantial growth opportunities in T. Rowe Price, and I plan on capitalizing by simply being patient, letting my shares compound with that dividend growth, and of course, allocating that capital in the smartest way possible. I have a lot of faith in the management team. The payout ratio is great. The dividend growth is consistent, but it's not crazy double digits, but it is relative to business performance, and management does a very good job of reallocating that capital and reallocating it within to the business so it grows. So you got a great company, great revenue growth, and they understand the economics of the business, and they don't act dumb when it comes to reallocating capital. And that's really one of the biggest things that I look for in a company, is the ability to reallocate the capital, reinvest back into the business for substantial returns. An example that I'd like to use, because I fell for it too, was AT&T buying Warner Brothers Discovery. So that was a terrible acquisition. DirecTV was even worse, but it was an example of a management that had extra cash on hand and just bought what they wanted to buy. They didn't look at synergy, didn't look at how well it would be integrated into the current business. And they had this vision for the future saying, I think that streaming on your phone is going to be the way of the future, which that I think it was correct when AT&T's management said that, but DirecTV was not a part of that. DirecTV is an old cable business that has obviously been declining since innovations have happened in that space, in that market. And so since the fundamentals changed within the business, they bought DirecTV, then they bought an actual streaming service and tried to make that part of their telecom conglomerate, and it didn't work out. So how management decides to reallocate capital back into the business, the acquisitions that they choose, because technically when they spend money, they're spending your money. They're spending your hard-earned money that you've invested in buying another company, and if they don't get substantial returns on that money, then they are burning your money. Essentially, they're throwing it away. So that's one of the things that I really do like about T. Rowe Price and Apple. A lot of the companies that I own, is I have confidence that they are very strategic and knowledgeable about how they reallocate capital, and I want to stay away from those companies that have made mistakes in the past, or I don't have confidence in when it comes to investing for their future profitability, which in turn is my future returns. Next, of course, we've got Google. So I bought a share of this on Monday morning. I was going to buy it Friday, and I didn't do it on camera, guys. Sorry about that. But I forgot about, Easter is, more than a one-day holiday. So right now, Google's sitting at 155.21. Market value reflects that. Average cost is 155.47. 0.29% of the portfolios on Google. Today we're down $1.30. Total, we're down 30 cents. So guys, I do have a small cost down average opportunity here in Alphabet, but I don't have enough free cash right now to buy another share. So my plan is, if Google is still down, I could buy another share with that Altria dividend, as well as I could either buy a share of Google and then use the rest left over to buy Realty Income, or I might just buy Realty Income. It depends on where the stock prices are, of course, when that dividend gets paid. But I love Apple. I use it every day. I upload videos to YouTube, so it's dumb not to own my technically they're my boss if I ever get paid from YouTube. So might as well get a little bit of that profit. And the real thing is the growth. I'm excited about growth for Google, and I want exposure to the business. So I do want this to be one of the top 5 foundational stocks for the portfolio. Even though it doesn't pay a dividend, I think it will give me substantial growth in the future. So I love Google, and it will be one of the bigger positions in the portfolio. Then, of course, we have the 3 companies. Visa is going to be bought. That's the other thing, is I do want to buy Visa with that Altria dividend if I have enough cash at the time. So Visa should be bought by around the end of April. And that is because I use it every day. I swipe my card, Visa gets paid. So they own a payment network, not cards, but I do understand the business. I love the return on invested capital. Of course, they have a huge competitive moat, and I want some exposure to that. So I love Visa, and it will be added to the portfolio by the end of April. Then, of course, we have our other two quote-unquote growth stocks. Berkshire, I need to own simply because I love insurance. I think Geico is one of the best-run insurance companies, as well as I want a piece of See's candy, right? I know it's not a very big business for Berkshire, but it is one of my personal favorites. I think they have the best candy in the world. I haven't tasted all the candy in the world, but out of what I've eaten in my life, See's candy is my favorite. As well as BNSF Railroad. I love railroads. I just don't understand them very well. So this is my way of getting indirect exposure through Berkshire. I don't want to own a single railroad. I'd rather own a railroad that's attached to a, huge conglomerate of other businesses. And that's really what I love Berkshire for, is they own a brick company, they own paints, they own so much. Like, I can't even go through it. Like a candy company, they own a huge amount of insurance companies. And so I've looked into companies like Allstate, like Chubb, like Travelers, and I do like those companies, but I would much rather own something more than just an insurance company. And just like I said with AT&T and T. Rowe Price, some companies are bad about buying businesses, some are good, right? About reallocating capital. And I love that Berkshire uses float to buy more companies and reinvest more back into their current businesses. So, of course, not every company that they buy is going to be a winner, but overall, in the grand scheme of Berkshire, they've done a very good job at reallocating capital, and they're very smart when it comes to just sitting on their ass and doing nothing with money when there's nothing good to do with the money. So I have utmost confidence in Berkshire. In fact, when it comes to management teams, they are my favorite. I do think that the legacy of Berkshire will be very well protected by who they are picking for the follow-up for Warren and Charlie, being Greg Abel and Ajit Jain. So, love Berkshire, and it will be one of the bigger positions in the portfolio. Then, of course, we've got Meta. So I want to buy Facebook around. Oh, and I want to buy Berkshire around $300 a share. So not buying it there, but I do want to buy Meta at $2 to $250. So I'm going to wait for a substantial drop, but I do love that they do pay a dividend now. So I do want to own Facebook, but just not at these prices. I do like Mark Zuckerberg. I think he's a great CEO. He's dealt with a lot of the scandalous shit that they've thrown at Facebook over the years very well. And I do think they do have a competitive advantage. And I understand the advertising business when it comes to online advertising pretty well. And I think they have a lot of similarities to Google as in their moat. Google's search and ad revenue through YouTube, and Meta is technically ad revenue through social media platforms. So the only reason that I was iffy on Meta for a long time was because I didn't feel like I felt like they might be outclassed when it comes to new social media, and I'm a lot more confident in that Facebook moat now. So with that being said, guys, I want to say thank you so much for watching. Remember to hit the like button on my channel, That Dividend Guy, and make sure you hit the subscribe button so you don't miss another episode. I post Monday through Friday, as long as the market's open. But with that being said, guys, thank you so much for watching. Remember to hit the subscribe button, and I'll see you tomorrow with another Robinhood portfolio update. Take care, guys.